products and then they are selling. So this is the situation that you can imagine. They all are the part of one big group, which can be said it is a multinational enterprise because it's spread across the country. And they often do businesses with each other, like buying, selling, providing the services, and having so much more transactions with each other. But there's a one big question: what price they should charge each other? And that's where the concept of transfer pricing comes in. The related parties might be tempted to manipulate the prices to gain the tax advantages. For example, let's understand this also by example. The factory in India is selling products to the UAE sales company at a very low price. This makes profit in India look so small. Despite being India the high tax jurisdiction, taxes in the India will be this low. Meanwhile, the UAE company earns a huge profit, and as we all know, compared to India, UAE has a low taxes. That you can say that that's a clever strategy, right? Isn't it? You can give thumbs up or something like that so that I can understand. All right. Now you might be thinking that that sounds like a clever trick to save taxes. If that has crossed your mind, that's okay. But you are not wrong. But it was a clever trick. It's not a clever trick anymore. But there is a catch. It didn't go unnoticed. This kind of strategic planning led to a global challenge: base erosion and profit shifting. BEPS. That's a jargon, tax jargon. So let's decode what is the BEPS. Over the time, governments realized that profit shifting tactic was being used globally. Here, that was happening. Profits were shifting from high tax jurisdiction to the low tax jurisdiction. High tax countries were losing their tax revenues, and governments of those countries were losing billions of tax revenue. They weren't happy. This was not just a planning, it became a systemic loophole. And that's why they have come up with the idea of regulating the transfer pricing to close the loophole. The idea behind bringing the transfer pricing rule is to ensure that related parties transact fairly, just like an independent party would have. Someone please mute themselves. It's creating a
नेट
noise.
हुआ नहीं हुआ बस
Background.
है उसी का रश।
फल क्या होगा ना ट्रैफिक, लेकिन ज्यादा ट्रैफिक में थोड़ी
Okay, let go again. So, they like why they have the idea behind transfer pricing rule is just that related parties should transact fairly, like independent parties would have in this situation. They say that even if two companies are related, they must set prices at independent parties would have. This is known as a arm's length principle. We'll understand about principle in upcoming slides. So if your company in the UAE is buying something from your company only, which is in another jurisdiction, you must ask a question: what would I pay to that company if that was a independent third party? That's when that's what the price you are expected to use, and which that's when the concept of the transfer pricing will come into picture. Now, move further how this will have impact. We can understand with this numerical example, like will numbers will give you the better clarity about this. So it's like a why the need of transfer pricing, why the transfer pricing is needed. Let's take a real life example again. So everybody is knowing that diamonds are getting Surat is a diamond hub of India, and very it's a very good diamonds are getting exported from India. So let's take it that example only. So suppose there is a diamond polishing company, hypothetical example. So Shine Gems India Private Limited. It's in Surat. It's exposed polished diamonds to the global buyer. Now imagine they want to sell a consignment, again hypothetical number, USD 200, to a customer in UAE. In this case, Shine Gem sells directly to the customers in UAE. What will happen? It will earn the revenue of $200. Cost of polishing and procurement, you can say that cost of goods sold, it will be 120, leaving the $80 profit for the Indian company in India jurisdiction. And India is the high tax jurisdiction, taxable at 30%. So it will roughly will be $24 will be the tax to be paid in India. That's the straightforward example. Now imagine Shine Gems set up a subsidiary in UAE. Let's call Shine Gems Dubai LLC. This is the again hypothetical name. Shine Gems India is selling diamonds to the UAE company at 150, not the $200 that it would have to the independent third party customers. And Dubai entity sells the customers at a full price, that is a $200. So what will happen? India's revenue will be 150. Cost will be the 120, leaving the $30 profit behind for India, and will be taxable at 30%, will come around $9. UAE's revenue will be 200, and cost will be the cost of purchase that it has purchased from the Indian entity, will be $150. Profit will be the 50, taxable at 9%, it will come around the 4.5. If you say that global profit will remain the same, that is the $80, but the total tax will be the $13.5, which is almost half. Just by rerouting the sale, group company has shifted most of its profit to a low tax jurisdiction, that is a UAE. Is this wrong, you will ask? Well, not necessarily, but if UAE entity is performing the real economic activities, then but if it is a paper company, UAE company is a paper company, then tax authorities in India will likely to say most of the value is created in India. The UAE entity shouldn't be keeping such big share of the profit. That's exactly transfer pricing regulation exists. This example shows that how multinational enterprises, because of its global footprint, can shift profit from high tax jurisdiction countries to the low tax jurisdiction countries, even when the total income remains the same. As we have seen, that total income is remaining $80 in our example. Same, this is the similar situation that used to happen if no transfer pricing regulations were existed. So now global tax authorities require businesses to prove that profits are declared where the real economic activities are being performed, and pricing between the two group entities is at arm's length, just like if they are acting as an independent third party. So this is the this has required the transfer pricing. Any doubts, anything that you want to ask up till? Are you
The
understanding?
questions we would take at the end. We'll take up the questions at the end in interest of time. So quickly we can make the audience understand what is related party. Because while listening to you, I had a constant doubt that you are referring to related parties, but what is this related party? So we
Yes.
can make audience quickly understand what is related party, connected person, and jump onto the myths.
Sure. So now coming further, let's understand purpose of the TP regulation. Let's just quickly understand. You must have got why this is, but let's just to clarify this. We have seen how profits can be shifted across the borders. Let's talk about why transfer pricing regulations exist in first place. They to ensure that related parties price their transactions just like independent business would. That's called an arm's length principle. Secondly, the governments to protect their tax bases, especially in high tax countries, by discouraging the artificial profit shifting. And finally, they promote the fair, transparent taxation. So every country should get the rightful share of their taxes. In short, TP regulations are all about the fairness, consistency, and integrity in the global businesses. Now let's move on to the related parties. Before that, let's understand what are the key regulations in the UAE. So there are federal tax there are about 70 articles. But apart from that, there are only 4 articles which are the main articles for transfer pricing purpose. Again, let's understand with an example. Imagine you are managing a vault full of valuable articles, right? The vault has just 4 locks, small in number, easy to overlook. But one lock is loose, entire vault is at risk. That's how these articles are also work under the transfer pricing law. Each one is looking very short and simple, but together they will protect the UAE tax system. Let's understand how. Article 34, you can say that this is the main law. It talks about the arm's length principle that we were talking, that it should be at the related party should price their transactions at arm's length, like they are acting like they are the independent third parties, just like it would have been two strangers. Now come to Article 35. It is like who is holding the key, because it defines the related party control, who will be considered as a related party, what will be the control, in what cases TP will be triggered. So these are the things that are covered by the article. Now again, Article 36. It is like monitoring your cash. So while making payment to the connected parties, let's say insiders of your business, it should not be the tax saving. It should not be for the tax saving purpose. It should be for the business purposes. That's why they have kept this article. Let's go to the article number 55, which is which you can say that it's a paper trail lock. It all talks about the requirements to maintain the documentation. What are the documentation that you are required to justify your transactions with your related party? So yes, just 4 articles, but together they act like a security system of UAE tax framework. Missed one, all vault is exposed. Follow them, you are fully protected. Let's move further. Let's understand what are the related parties. Again, this article will help us to understand who qualify as a related party under the UAE Corp Tax law. First one is individuals who are related to each other. If 2 or more individuals are related by, let's say, family relations or kinship up to 4th degree, we will see this, what is the kinship up to the 4th degree. We'll see this in our next slide. So right now, just remember this. If 2 or more individuals are related by family or kinship up to the 4th degree, they will be treated as a related party. How they will be treated, we'll understand with an example in our upcoming slide. Second, if individual and company, if any person, individual is holding any control or ownership, which is more than 50% in any, directly or indirectly, in any juridical person, then that juridical person and individual both will be treated as a related party. In case of 2 or more legal entities, if one company is owning control in another company, or they are under the common control or common ownership, which is where ownership is 50% or more, they are related parties too. Other relationships that can be like PE. If you are having a permanent establishment outside UAE, let's say example is a branch. If you are having a foreign branch, then that branch and your company in UAE, both the companies will be treated as a related party. Another example would be partner in an unincorporated partnership. People involved in a trust and foundation, like trustees, founders, beneficiaries, those will be treated as a related party. Now let's briefly understand what will be the control, because till now I am talking about it is owning or controlling. Now they have also defined what is the control. Control doesn't just mean the ownership. It includes if you have a 50% or more voting rights, if you are in a position where you can appoint the more than half of the board of the directors of any company, this situation will also lead to the creating control in any juridical person. If you are able to receive more 50% or more profit, or you are having significant influence over any business, this is the main they have defined each and everything. If anything is not covered by this situation, then if FTA is able to establish that you are having significant influence over a business, then you will be treated as a related party, and transactions should be at arm's length. In short, Article 35 tells us if there is a family connection, common ownership, or influence, then these parties will be treated as a related parties, and transfer pricing regulations will be applicable in this case. Let's move further. Let's learn about the degrees of kinship. UE tax law doesn't just look at the corporate ownership, it considers family relationships called degree of kinship to identify the related parties. And this will be like up to the fourth degree. Like first degree, you can see that there is an individual and the spouse. Then in the first degree of relative, you can see the parents and child. Second, grandparents, siblings. So up till fourth degree, which will also include cousins, great grandparents, and all. So in short, your family circle is considered related party, and if your business is having any transaction with their businesses, whether in individual ownership or in partnership, with whichever the form, it will be treated as a related party, and TP needs to be complied. Now let's understand with this example, you'll get a better clarity about it. One is when individual is running a business, and his cousin, let's say his cousin or sibling, is a partner in a partnership firm. Now if individual is having any transaction, like individual's business is having any transaction with the partnership firm, it will fall in the transfer pricing rules. Why? Because as per Article 35, individual and that person who is a partner in the partnership firm, both will be treated as a related party by degree of kinship, by the degree of kinship. And further, partner in partnership firm will be also treated as a related party as per the Article 35. So if individual in any business capacity is having any transaction with the partnership firm, like indirectly, then also they will be treated as a related party, and this will be brought under the purview of TP. So even indirect family connections combined with the business transactions can trigger the TP compliance. Now let's move further. Article number 36. This talks about the connected person. Let me tell you, rather than going by this slide and all, let's just understand this by the, you just see the reference of the this slide, and I'll give you the example. So let me tell you that there's a one person called Ayan. He's running a successful consulting firm, or you can say consulting company in UAE. He is the owner, but he is not doing it alone. The office building that he is using is owned by his wife, and the company is paying rent to his wife. His brother is also a director in that company, and his cousin is a partner in some other company, where the company they have outsourced the work to this Ayan's company. To the outside world, it looks normal, but from tax perspective, here's what is happening. Article 36 will apply. All these people will be treated as a connected person. Why? Because Ayan has a ownership and control, so his wife is a connected person. His brother, again, by degree of kinship, will be a connected person, and he is the director. If he is getting any payment from the company for the services that he is providing, will also be treated as a payment made to a connected person, and it should be at arm's length. His cousin is also partner in some other company, but they are having the transaction, partnership firm and this company is having transaction, again will be covered as a related party, and arms and price need to be followed. But connected persons are in the, because why? Because connected persons, they are in the position to influence the business. So if payments are inflated or manipulated, it can be used as a tool to reduce the tax, avoid the tax. As we all are aware that there is no personal income tax in UAE. So if they are paying salaries to the directors, they will be able to claim it as a deduction while computing their profits, right? So if they are going to, if they are able to inflate this salary, they can reduce the tax liability and they can pay the lesser amount of tax. In order to avoid this situation, they are having this situation. So it is all about the fairness filter. So if you are paying someone who is close to you, family, business partner, or a board member, make sure it is at arm's length. It should be at arm's length. Now I will hand over to my colleague Kinjal for the myths.
Thank you, Asta. Thanks a lot. I think you wound up on perfect time. 30 minutes is something what I have, and I have 6 myths for the audience. So I have 5 minutes for each myth, which is a sufficient time to break it. So let's go on to the first myth. Can you go on the next slide?
Sure.
Instead of breaking the myth directly, I want audience participation to see if they feel it's a myth or if they feel it's a fact. So what we'll do is we'll display the myth as a question, and then audience, if they feel it's a myth, they can react a thumbs up. And if they feel it's a fact, then they can raise their hand for simplicity. Okay? Breaking down the first myth for you or a fact for you. Are small or medium-sized enterprises exempt from TP compliance? Can I have audience participation? If you feel it's a myth, please go on and show me a thumb. But if you feel that it's a fact, I want your hands to be raised. Oh, I see a mix of hands raising and thumbs. So, Asta, let's break this down. Only large multinationals need to worry about TP. Absolutely and absolutely a myth. What is a fact is that, can we see Asta? Any business, large or small, must comply with TP rules if it engages in related party transactions. I am a small business. My turnover is less than 3 million dirham. I am not going to file my full-fledged return. The return for me is also very short. So who is FTA to ask me that, okay, I should comply with transfer pricing? Let me break it down for you. The transfer pricing guide very explicitly states that exempt person or even people who are claiming small business relief, if they have related party transactions, yes, they are spared from a very big compliance, which is maintaining the documentation. But at any point in time, all the businesses in UAE are required to conduct the transactions at arm's length price. Just showing you a very simple example. If there's an Indian company and there's a UAE company, and the UAE company has just a revenue of 82 million, and that company is claiming small business relief, amazing. A lot of compliances go. You have to file a very minuscule return because you are claiming a small business relief. But that does not mean you do not have to do TP. You would have to at least make sure that your transactions are at arm's length price. So TP is not for global giants like Apple or Amazon. Small as well as medium businesses dealing with related parties should make sure that they comply with transfer pricing. Even if you are paying zero tax, you have to make sure that you comply with transfer pricing. The basic principle of you might not do the full-fledged transfer pricing of maintaining documentation because you are exempt if you are a small business, but you need to make sure that all your transactions are at arm's length price or they are questionable. Can we go to the next myth? And this is my favorite one, where most of the people are confused. Is the transfer pricing compliance necessary only for cross-border transactions? So if you all would have heard Astha carefully, she kept on saying that there is a company in one jurisdiction and then there is a company in another jurisdiction. The reason why she kept saying that is this is how transfer pricing works. It is never for same companies in same jurisdiction, because if I am in jurisdiction A and my related party is also in jurisdiction A, we both would be liable to a same rate of taxation. In that case, where is there a case of base erosion? There is not, right? Because expense for one company would be an income from another company, and therefore there is no base erosion practically. So ideally, if I would have to look at an ideal scenario, in that case and across jurisdictions, transfer pricing applies only and only for cross-border transactions. But do we all disagree more to the unique nature which UAE has in terms of offering benefits to the businesses? Do we doubt that? Is it the only entity, is it the only jurisdiction which has corporate tax but does not have personal tax? Of course, there are other jurisdictions in other parts of GCC as well who have this unique structure. But when I talk specifically about transfer pricing, let's break that myth, Astha, for the audience today. TP doesn't apply to transactions within UAE. Absolutely and absolutely a myth. And this is one of the biggest myths which is affecting businesses and which is keeping businesses away from transfer pricing. The myth buster for you today is that transfer pricing rules do apply even when all the entities are UAE based, even when all entities are subject to 9%, transfer pricing rule does apply. Let's break it down further for you. And let's look at how much at a risk you are if you don't comply with these transfer pricing rules. Very simple example. A company is in foreign jurisdiction and then it has 4 subsidiaries in UAE. BCO, which is in mainland, CCO, which is in free zone, DCO, which is again in free zone, and ECO in mainland. Very typical structure which we would have seen for many of the companies. Let's decode, will transfer pricing apply between different permutations and combinations between these entities. Starting first with a very simple one, ACO in foreign, BCO in mainland. There is a possibility that ACO in foreign would be taxed at a different rate of 9%. And BCO in mainland would be taxed at 9%. Given it is in UAE, it is in mainland, it would be subject to tax at 9%. In this case, does transfer pricing apply? It definitely applies because there is a foreign jurisdiction involved and there is a mainland entity involved. The next question becomes more interesting. There is ACO in foreign and DCO in free zone. Now, this DCO in free zone could either be subject to 0% or could either be subject to 9%. But given that we have ACO in foreign, I don't think anyone would debate that transfer pricing would apply. The third situation is an ideal case for transfer pricing when transactions are being dealt within UAE. There is a CECO in free zone and there is an ECO in mainland. CECO might be potentially subject to 0% and ECO would be subject to 9%, which means there is a very likely chance that, okay, if I am a smart businessman, what I would do is I would have more of income in CECO and less of expenses in CECO and try to give higher income share to CECO because I would not have to pay any taxes there and reduce my profits as much as I can for ECO. In this case, it is very explicitly stated in free zone guide as well as the transfer pricing guide that when we are seeing such a transaction between a free zone company and a mainland company, for the free zone to get that 0% benefit, transfer pricing is one of the key conditions. And therefore, there is no debate in this case that transfer pricing would apply. So CECO and ECO we have cracked. Until now, every answer I have got a yes, by the way, that transfer pricing would apply. Now I'm seeing a transaction between DCO and CECO, free zone to free zone 0%. What do I have to do with transfer pricing? Everything is taxed at 0%, right? But for claiming that 0%, you have to comply with transfer pricing because that is one of the key conditions. And therefore, again, transfer pricing will apply. And last case, which is very peculiar and which is a myth, between BECO and ECO, two mainland entities. When I'm dealing with two mainland entities, my BECO is also subject to 9%, my ECO is also subject to 9%. And why do I have to do transfer pricing? You have to do transfer pricing because the transfer pricing law of UAE clearly states that transfer pricing is also applicable to domestic transactions. So, as per UAE corporate tax law, related party transactions must meet the arm's length principle regardless of party's location. And the law does not exclude domestic transactions from TP compliance. And that is the reason, even if both the companies are taxed at 9%, still you would have to go and do that extra step, make sure that your transactions are at arm's length, and do the transfer pricing compliance. What is the risk if I don't? Kinjal, what is the risk if I don't? Let's see it in the next slide. So here is all the possibilities of transactions which are possible. One is mainland to mainland. TP is definitely applicable, but I'm sure that unless there is a situation where one entity is loss making and another is not, you would not evade the base erosion principle. And therefore, if you see, we have only first one highlighted in blue. That is, there would not be any case, ideally, that you would have evaded tax in this case. And therefore, the TP risk might be a little lower, but still, as per the rules, you do need to comply with transfer pricing. Remaining all the situations, whether a mainland free zone, a mainland foreign, free zone mainland, free zone, and free zone foreign, everywhere TP is applicable. If you are a free zone entity, you might be at a risk of losing that 0% benefit, not for 1 year, but for 5 years if you have not complied with TP. And therefore, it is very, very critical that we do comply with TP irrespective of our locations. I think this was the biggest myth which was there when it comes to transfer pricing. And it gives a logical challenge as well to businesses that why do I need to do this? But you need to do it because UAE, the law has evolved newly. We do not have any precedents. We do not have any, what do we say? Precedences in the past would say that, okay, you are at a low risk or you are at a high risk. Therefore, as we stand now, you have to comply with TP. Now I can see one question which I want to take it immediately. Why 5 years? Because if you do not cut, so for the benefit of everyone, when you are a free zone company, to claim the benefit of 0%, you in the first place have to make sure that you comply with 6 set of conditions which are there. One is the condition of substance, that you have enough substance. Second is you satisfy the condition of de minimis, that is the revenue from your non-qualifying activities. I would not go into the conditions in detail because this is a TP session, but just for the benefit of the audience. Second is the de minimis, that your 5% or 5 million, whichever is lower, your income from non-qualifying activities should not be more than your qualifying activities. That is the second condition. The third condition is you have to do audits. Mandatorily, if you are a qualifying free zone person, if you want that 0% benefit, you have to finish your audits. Fourth is an option that you do not want to voluntarily go and opt for 9%. That is the fourth condition. And the most critical, important condition which you have to do is you have to comply with transfer pricing. So when I say you have to comply with transfer pricing for claiming that 0%, if you do not comply with transfer pricing, then it is specifically stated that once you lose the free zone person benefit, the 0% benefit in year one, that disqualification is not just for year one, but is there for next 4 years as well. And therefore, I mentioned that if you do not do TP, you will lose the free zone person benefit, not for year one, but for 5 years. That is the logic behind 5 years. Asta, can we quickly go to the next myth? Be rest assured, we will take your questions at the end. This is an interesting one and requires a lot of engineering to be done at an organizational level. I was very scared of TP, and therefore, what did I do? Is I settled all my transactions before the year end. I did not make that transaction reach my year end balance. And therefore, when I settled the transactions with related party before my year end, are the transactions outside the scope of transfer pricing? Can I have either a thumb or can I have a raise of hand? I saw one myth. Oh, a lot of myths. I think everyone knows this. Still, I see two people who have raised their hands, three now. Okay, let's break this myth, Asta. If there are no outstanding balances with related party at year end, TP does not apply. Absolutely a myth. Can we see the myth buster? TP applies regardless of whether the transactions are settled or outstanding. So assuming, can we go to the example? Assuming there was a loan which the parent had provided to the subsidiary and they both follow December as their year end. They provided the loan on 25th March and they repaid back the loan in 30 days. Does transfer pricing apply? Of course it applies because there was a transaction which was undertaken between related parties during that year and therefore transfer pricing would definitely apply in such a case. And when you go to your consultant, there are four typical questions which your consultant would ask you, which you would not like. And I would like to make you aware of those. First question which they would ask is, given that this part of the region, no one follows a practice of charging interest, the first question to you would be, was the interest charged? Then the second question to decode would be, was the interest which was charged, assuming I have just charged a random amount of 5 to 6%. Sometimes it might justify, sometimes it might not justify, depending on the credit rating of the borrower. So in that case, was the interest charged at arm's length? Third question, agreements. Do we maintain those? Do we have a practice of maintaining those? If not, they are a very, very crucial document for transfer pricing, and we should have the practice of maintaining this document. The loan has to be documented formally. And when you're documenting the loan formally, one of the key things, one of the key clauses which that agreement would include is the repayment terms. We have generally seen that, okay, even if it is documented, even if there's an agreement, there are no repayment terms which are there in the loan, which makes the loan a very loose end. And therefore, we've advised all of our clients that please do have repayment terms, because in that case, it does make the benchmarking exercise also easy. A benchmarking exercise is very vague and cannot be performed when you do not have a repayment term associated to a loan. So it is very crucial that we have all this in properly documented in the interest in the loan agreement which we are preparing. And even if there's no balance outstanding since the transaction was conducted during the year, you will have to go ahead and do the TP. I see a question. What if I don't charge interest? If you don't charge interest, then FTA has the rights, if it has identified and observed this transaction, to go ahead and do a transfer pricing adjustment on this loan. What would happen because of this? Because of this, the entity which has given the loan would have to make and transfer pricing adjustments in its book and go ahead and charge interest. Now, a second alternative question which comes is, okay, my entity, my group entity, my parent who has given me the loan is in a foreign jurisdiction. So if I don't charge interest, it is not my loss, but it is that parent entity's loss, because it is income of that foreign entity and expense of my entity. In that case, we've seen there are no precedences in this part of the region, but there are precedences in other part of the region which shows that when there is no base erosion at a regional level, it might not have a major risk. So in to answer your question, Mohammed, if I was the provider, if I was the receiver of the loan, and I had not charged any, I have not booked an interest expense, which would reduce my profits, still I'm at a little lower risk because there's no base erosion at my level. But to comply, if I have to comply with TP, if I was a qualifying free zone person, I would have definitely charged interest on that loan. Otherwise, it would become a transfer pricing non-compliance and it would not make me avail the free zone person benefit. Asta, can we move on to the next question? Do you think simply disclosing the related party transactions in audited financial statements ensures TP compliance? I have discussed everything with my auditor. I have told my auditor everything, and he is going to disclose the transactions in the financial statements. So I am not at risk because my financial statements are correctly reflecting what transactions I have entered with my related party. Is that a requirement that you only disclose your transaction in the financial statements? Because Astha kept repeating again and again that whatever transactions you have to incur, those transactions have to be at arm's length price. So the requirement of transfer pricing is not that you disclose the transactions in the audited financial statements and you tell everything to the auditor, but the correct set of requirement is that my transactions which are there are on arm's length price. Will my auditor go and vouch that what transactions I have entered were at arm's length price? No. It's not my auditor's duty to go and vouch whether what I have entered is on arm's length or is not on arm's length basis. There's a separate exercise which is involved for it, which is called as a benchmarking exercise, which we will discuss in length in the upcoming sessions. But my auditor does not vouch for my transactions to be at arm's length price. Neither it is auditor's responsibility. What is auditor's responsibility is to see that, okay, all the related party transactions which are there are correctly disclosed in my financial statements. So can we bring up the myth, Asta? Audited financials ensure TP compliance as long as the related party transactions are disclosed. Pricing isn't an issue. Absolutely myth. What is the buster? Disclosure and audit alone don't prove in compliance. TP is about accurate arm's length pricing and not just reporting in your financial statements. So we need to make sure that whatever is reported in the financial statements, if you are in a position to conduct your TP exercise before your audit, and if your auditors, if you have already given that TP reports to your auditor, because I'm sure your auditors must be asking you this question. Have you done a transfer pricing impact assessment? Do you have the supporting benchmarks for the transactions you have entered? If all of this is already in place, please go and share with your auditor. If it is not in place, then please do not assume that whatever auditor is disclosing in the financial statements is correct. You would have to undertake the TP exercise, and basis TP exercise, if you have any adjustments, you will have a responsibility to go and disclose that in your return of income. Next myth, quickly, Asta. Yes, I think I've explained this, so we can move. Now, again, this is a question on documentation, and the time we have today would not justify it, and therefore we have an entire session on transfer pricing documentation, because there are penalties which are involved when you don't maintain your transfer pricing documentation, and there are other side effects to it too. So we have an entire detailed session on documentation, but just for the purpose of breaking myth, is it true that UAE businesses do not require to, can I see the question, Asta? Don't need to maintain detailed TP records. It depends on various factors, but let's come to the myth first. TP documentation is optional in UAE. Absolutely a myth. Anyone which tells you this, please don't believe them. And the buster is TP documentation is not optional. Taxable person must prepare it if the certain conditions or thresholds are met. There are a lot of conditions and thresholds which are associated to maintaining the transfer pricing documentation, which we can have a look in the next slide. So if you would have heard what kind of transfer pricing documentation exists. One, which we would have heard, is the transfer pricing disclosure form. Now, transfer pricing disclosure form is not a very separate document. It forms very well a part of your return of income. And you need to fill those forms when your total transactions with related parties exceed AED 40 million. That is the first step where your first compliance triggers of disclosing. Your second compliance triggers when your transaction with each party, when you have a transaction with a related party and your transaction with each party exceeds AED 4 million. And as Asta rightly said, there are transactions with related parties and there are transactions with connected person. So if your transactions with connected person, if I'm paying my director remuneration of more than AED 500,000, then again the disclosure requirement kicks in. So there are 3-4 disclosure requirements which are there when we talk about transfer pricing disclosure form. That's the first set of document which we need, where first compliance would get triggered. Second is my local file and master file. A lot of you must have heard these two bombs, local file and master file. But there is a relief that if your turnover is exceeding AED 200 million dirhams, only then you need to prepare these set of documents. And these set of documents are nothing more than your internal policies and procedures which you have maintained to make sure that your transfer pricing compliance is correctly done. This third requirement, which is older than the UAE law. The UAE law came in 2023. The CBCR kicked in UAE in 2021. And since then, multinational groups with a consolidated revenue of more than AED 3.15 billion have been filing their CBCR reporting and have been doing it. So if you fall under this category, this is another requirement which you should be take care. Now someone asks me, what if I don't meet any of these thresholds? Am I not supposed to comply with transfer pricing? Am I not supposed to have transactions at arm's length? We should understand that there is a very thin line of difference between what is need to be done and what needs to be reported. Your transactions, irrespective, have to be at arm's length. So that is the thing which has to be done. Second step is, what do I need to report? You need to report only when you meet this threshold, but irrespective, all your transactions are required to be at arm's length. Another set of questions which people come and ask us is, do I need to submit this local file, master file, and the return of income when I file it? Not required. The local files and master files and all the supporting documents would be required only when FTA specifically requests for it. But FTA, once it requests for it, will only give you 30 days to submit all of this. And it is impossible by any stretch of imagination that you would be able to produce these documents in 30 days if you would have not done a compliance before. Accordingly, please start early. You are already late if you have not started, then please start now. Can we go to the next myth, Asta? I think this is the last one. Thank you. Can businesses defer TP compliance until they finalize the year-end accounts? Why this myth? Because I'm sure everyone is in the process of finalizing your year-end accounts. And I'm sure your auditor must have come to you and asked for your transfer pricing reports. And that myth would have been busted in itself that, okay, I was not supposed to do TP at year-end, but I should have started it along with my transactions as and when they would have taken place. And therefore, this is again a myth that you need to do your transfer pricing compliance only at year end. You would have to do it alongside your businesses, because if I have to explain you how the TP process looks like, can we go to the next slide first? Let's break the myth for them and then let's show the audience how the TP is ideally conducted. Transfer pricing only matters at year-end audits. Yes, it would matter at year-end audit only if your auditor would ask you, but it is not the case. Can we show the myth buster? Transfer pricing is not a year-end formality. It begins with the decision to deal with the related parties and runs through to the execution, compliance, and audit preparedness. Accordingly, we should have started until now. Can we look at the process of transfer pricing? There's a planning phase, there's a compliance phase, and then there is an audit phase. So if we have to look at it, our step one starts at identifying who are our related parties. Then it starts with planning those transactions with the related parties. There's another jargon which is there in the world of transfer pricing known as FAR analysis, which is you need to analyze your functions, assets, risk performed. We will take all of this in our next upcoming series and therefore not covering here in detail. But yes, you have to analyze those transactions. You have to sit with your board. You have to prepare your TP policies. Your consultants might even interview your employees to know what functions they perform. You have to make year-end adjustments if they were not done throughout the year. Those are called as true ups and true downs in transfer pricing world. And finally, you have whatever you have done, you have to document it, followed by your audit. So in case, but the way it is moving in UAE is the reverse way. First, there is an audit, which people are initiating. Then they are thinking what documentation should be maintained. They're thinking that, okay, how will I give the adjustment to true up, true down? And then the planning phase is left somewhere behind. That was not the ideal scenario in which the transfer pricing would have been conducted. But yes, we are living with the situation and we should do our best to comply with it now, if not later. With this, I think we've broken all the myths which we had. I know there are some questions in the Q&A. We'll answer it to them. Can we go to the next slide, Astha? You all have questions for us, we'll answer them, but there's a request which I want you all to make. Can we go to the next slide, Astha? There's a community which we run where we make such boring topics. We try to make such boring topics a little more interesting. So please feel free to scan this code and be a part of our community if you are not already a part of our community. In the meanwhile, I'll go through the questions which are there. Can we display the code, Astha? We can keep the code displayed unless we are solving one question. If there's any other question, please feel free to type in the chat box. Please, can you break one more myth? There is a limit of AED 40 million in CT guide for TP compliance. Below this, we don't need to do TP documentation. A lot of people say this, but it needs to be done. Can you put some light in this? And the same goes for connected person if director remuneration is below 500K. So let me break this down for you. First of all your transactions, the blanket rule which you need to follow is all your transactions need to be at arm's length price. There are no conditions associated to it. And this is even a compliance which is required to be done by small businesses. So if they are expecting the small businesses to do this compliance, obviously any business in mid-tier or big firm is required to do this compliance. So first thing, your transactions should be at arm's length basis, irrespective of whether they are more than 40 million or less than 40 million. Or if your payments to connected persons are more than 500,000 or less than 500,000. The next step after you've kept everything at arm's length is that now whom do I go and show that I have kept it at arm's length? Here is the relief. So if your transactions do not exceed, if your total related party transactions do not exceed AED 40 million, what would happen is when you go and file your return of income, there is a transfer pricing disclosure form, which opens only when your related party transactions are more than 40 million. If that is not the case, that form in itself would not open. So what FTA expects you to do is a self-compliance. Assuming I am a free zone entity, I do not have my related party transactions above 40 million, and therefore I'm not doing anything right now. I'm just sitting with my transfer pricing. Tomorrow, if my case is picked up for an FTA audit, what would happen is FTA would go ahead and ask me that please demonstrate it to me that all the transactions which you have entered are at arm's length price because you were a free zone entity and you were supposed to comply with transfer pricing rules. Then I would not have any documents to submit that my transactions were at arm's length price because I always assume that given that my transaction limit is 40 million, I have not complied with TP. And there is where FTA will take your benefit of 0% and will charge tax on you at 9%. Because as per the rules, all your transactions you enter with your related party, domestic or international, should be at arm's length. So yes, this is again a 40 million myth. You have a relaxation of reporting, but you do not have a relaxation of having your transactions at arm's length price. Is there any reference where we can check the market value of salary to connected person, which is acceptable by FTA? So unfortunately, as I said, this part of region is unique to have corporate taxes, but to not have personal taxes. And so we do not even have jurisdictional precedences which we can take from other mature jurisdiction to apply in that case. And therefore, as a jurisdiction stand, what everyone is doing is taking HR codes to benchmark their salaries. This is the common practice which everyone across UAE is following. Unfortunately, there is no reference where we can check the market value of salary unless we go to an HR. We show them the profile that, okay, this is the profile of an individual. Please, can you help me with a quote which will justify the time and effort and the qualifications of this individual? That is where HR consultancies will give you a quote which can be accepted, and that can be used as your valid benchmarking report. Person A and person B, who is person A's brother-in-law, each own separate companies with 100% ownership. There is no common ownership in any company, in any other company. In this case, with the transactions between company A and company B considered to be related party transactions? If so, could you please explain how? Astha, would you like to take up this one?
Sure, I would like to. So if you would have seen the degree of kinship diagram that I have represented, in that they were on
Can you go
first.
to that? Can you go to that slide again?
Okay. Just a moment.
Yeah, sure. Take your time.
So yeah, if you see this diagram that we have gone through, in this diagram, there is an individual and there's a spouse. So it is included if whether they are the individual's relative up to the fourth degree kinship, or they are relatives of the spouse up to the fourth degree. So spouse brother, that is a sibling, is also connected to that person. So if a person like that, Mr. A and Mr. B's brother-in-law, that is Mr. B, if they are owning a different companies and their companies are having any transactions, so they will be covered under the purview of transfer pricing regulations. Hope that gives a clarity to your answer.
Another question is the limit of 500K for related parties for TP compliance per director? So yes, the CT return guide, which has clarified these thresholds, do mention that when your per director, per connected person remuneration increases 500K, you have to go ahead and disclose it. So yes, this is the limit per director. And I can send you a reference of the guide where it is mentioned. I think we have answered more or less all the questions. Yes, we have. And can we again display the 4 TP series calendar
Sure.
which we have?
Sure.
Is the justification enough that transaction complying ALP or TP documentation should be maintained even if the threshold is not met? If I understand your question correctly, you are asking me if I maintain a justification that the transaction is complying with ALP, would suffice if the TP documentation is not met. So we are talking about how would you justify? You would be able to justify this when you have your benchmarking reports and your transfer pricing policies of your group ready that, okay, this is my group structure, and this is how I do transfer pricing. When you will be able to do this, when you maintain these set of documentation, not as exhaustive as local file, master file maybe, but something which justifies and which enables FTA to make sure that your transactions are at arm's length, it would be a fair documentation to keep. So I think we have just concluded our first session, breaking the myths about transfer pricing. The next session is really important because out of the 10 or 12 questions which I have attended, I think more than 50% of the questions related to documentation. So we will be covering documentations extensively in our session on 22nd May. Then we have the 29th May session would have common transactions in UAE, which we have seen, visas spread across group entities, funds moving freely across group entities. We would try and cater all those common transactions which are a part of this unique region. And on the last session, what we will do is we'll help you decode the benchmarking methodologies and other key topics of transfer pricing, where a consultant suggests you one method, you would be in a position to ask that consultant back, why have we done TNMM and not cost plus? We want to enable an audience to that extent. So thank you all for taking out time. We are 10 minutes overdue, but I'm sure some myths relating to transfer pricing would have been broken. And we look forward to having you all in our next sessions. Thank you so much and have a lovely evening.
Thank you, team.
Thank you, Astha.
Thank you.
Thank you, team.
Thank you, everyone.
Thank you, Astha and Panju.